Hello, learners. Welcome to this beautiful session of ours today. In our class today, I want us to handle a very important concept and very common in financial management advanced. And this is a concept referred to as a capital asset pricing model, commonly referred to as what? CAPM, commonly referred to as CAPM, which Mwalimu has shared with us here. But before we go to CAPM, remember this concept basically is under portfolio analysis. So that is to say, you must, I'm using the word must, you must be very good in understanding the concept of portfolio analysis. You must be very good in understanding the concept of portfolio analysis. That one you can't avoid. Recall, and if Mwalimu can just remind us on the concept of portfolio analysis. Ideally, portfolio, first of all, you have to understand is basically a collection of investment securities. This is basically a collection of investment securities. This is what you're referring to as portfolio, if you can recall what we shared the other time. And also at this point, you'll find that the main aim of portfolio formation basically is all about risk minimization. It's all about what? Risk minimization. And in this case, you'll find that we normally tend to talk of the total risk, which ideally it is also referred to as a business risk. And business risk, in what we did, recall, business risk, we said it is divided into two. It is divided into systematic risk, and number two, we normally tend to talk of what? Unsystematic risk. Unsystematic risk. So these are our risk is divided into two, systematic risk and unsystematic risk. Where we mention, and you clearly recall under systematic risks, basically we say that these are business risks which cannot be minimized by holding a portfolio. Meaning that at this point, regardless of whatever that you're doing, we can't minimize these risks. They are beyond us. A good example is like what happened during 2020 with the invent of coronavirus. These are basically risks that no business didn't, you'll find that we didn't have control over such. It is purely external. These are what you're referring to as systematic risk, type of risk which cannot be minimized by holding a portfolio, meaning that it affects all companies in the industry. It affects all companies in the economy. Example, what Mwalimu is talking about, what happened during 2020, right? COVID-19. Also, the other case can be war. These are aspects of risk that we can't control as a business. These are what we normally refer to as systematic risks. Whereas unsystematic risks, if you can recall what Mwalimu mentioned the other time, is that these basically are risks which can be minimized through portfolio formation. It affects basically specific companies. It affects specific companies. And that is to say, basically, this just we're just doing a recap of what we did, my good students, before we look at CAPM in large. You'll find that in the event that we are to look at our risks, these are what we'll be having. So basically, you'll find that up to this point, assuming this is our risks, okay, and basically this is our size of portfolio. Okay, these are size of portfolio. So looking at this, it will be important for us to basically recall what we said, that at this point there are these risks which you can't control, which are referring to them as systematic risks. So these are systematic risks, which you're having them here, systematic risks. Whereas there are these risks which we can minimize by holding a portfolio. So ideally, this is now what we're referring to as, unsystematic and systematic risks. It means that basically these are risks that we can minimize by holding a portfolio, whereas systematic risks, recall at this point, these are risks that affect the whole economy at large. They affect every industry, not only specific company. So these are some of the few items that basically Mwalimu shared with us when we were looking at portfolio analysis. So the first thing that Mwalimu is saying, even before we go ahead and look at capital asset pricing model, this is what we must be having at our fingertips: portfolio analysis concept. Okay, so once we have that case, my good student, other item that we should also be very good at this point is for us to recall the concept of efficient frontier curve, EFC curve, right? Basically, this is EFC, efficient frontier curve, which ideally this you can get it basically, of course, under the efficient set and optimum portfolio. The efficient set and optimum portfolio, which you would also look at it. So this knowledge, again, you must be having it at your fingertips. You'll find that basically under efficient set and optimum portfolio, we mentioned that there are portfolios with the following characteristics. That is, number one portfolio, we mentioned that those that offer the highest returns at a given level of risk, and those that offer the lowest risk at a given level of return. Where when we talked of EFC, right, when we talked of EFC, which we're referring to it as efficient frontier curve, you'll find that we will be looking at a portfolio which will dominate others in the market in terms of risks and returns, form what is not as basically what the efficient set, what we talked about, right? So they'll basically dominate all the others. It will definitely dominate basically all the others in the market in terms of risks, which collectively we refer to them as efficient set. So they are joined basically together by a concave line known as efficient frontier curve. So this efficient, these basically what we are referring to as the efficient set. They are going to be joined together by what now we are referring to as efficient frontier curve, which we did. This, remember, this is just a recap of what we did. So you must be having it at your fingertips for you to be able to handle portfolio or CAPM very well. Also, the other key item that you must be having at your fingertips before you handle CAPM, take us to number 3, is what we talked about, the capital market line, CML. Remember, CML, the capital market line. So this is a knowledge that you can't handle CAPM if you don't have the knowledge of capital market line. Recall, the whole concept of capital market line, basically, at this point, we normally tend to say that in the absence of risks, free securities, all efficient portfolios will be found along the EFC, the efficient frontier curve, which you mentioned. However, in the market, there are kind of some securities which don't contain any element of risk. Such security basically are known as risk-free securities, and their returns are normally represented by returns of treasury bills, for example, government bills. You'll find that the whole idea that these securities actually, they don't have risks, like treasury bills. You're very sure that you're going to earn that. Treasury bonds, these actually, they don't have any form of risks, right? So 3 main items that you must always be very good at while we are handling CAPM is, number 1, we've said portfolio analysis, the concept of systematic and unsystematic risks, because you realize that for CAPM, our whole idea basically will be on the systematic risk, this risk that we can't control as a business. That is the main basis of actually capital asset pricing model. So once Molimo has reminded us on the basic concepts that you must always be having before we look at CAPM, then that should take us to capital asset pricing model directly, that is CAPM. So allow me to erase this point here. I believe now we have the concept of what we are supposed to know before we handle CAPM. So on that case, my good students, looking at capital asset pricing model, what should we be able to know? Ideally, at this point, what should always tend to come at the back of our mind is that portfolio that are affected by systematic, this model handles portfolio that are affected by systematic risk only. Portfolio that are affected by systematic risk only. Portfolio that are affected by systematic risk only. These are the portfolio that you're going to handle basically under capital asset pricing model. And at this point, maybe to also explain it clearly, you must always be able to also, even before you go deep into that, it is very important for us to understand, because these are the assumptions that will always tend to guide us when we are handling CAPM. So you must always have these assumptions at your fingertips anytime you're handling capital asset pricing model. Number one assumption here is that the investor holds a portfolio which is fully diversified. That is the only prevailing risk is systematic risk, which is measured using beta factor. So this risk under CAPM, the risk that we'll always be having, of course, it will always be measured by beta factor. Right? So in this case, one of the main assumptions is that the investor holds a portfolio which is fully diversified, right? In essence, in this case, the only prevailing risk is systematic, which is measured using what? Beta factor. Then this is assumption number one. Assumption number two, my good students, we are saying that at this point, you'll find that the capital markets are efficient, meaning they are perfect. The capital markets are efficient. Capital markets are efficient. Because the concept of CNL, which I mentioned that you must be very good at. So ideally, in this case, ideally you're seeing that they are perfect, right? We'll be having form of risk-free. Number three characteristic here is that all securities in the market are liquid and divisible. Another assumption which will always guide us. Here we are saying that all securities in the market, all securities in the market are liquid and divisible. Are liquid and divisible. Number four characteristic here, which you can also mention, is that all investors in the market can borrow and lend out any amount of money at the risk-free rate. That is also another important characteristic here, which is saying that all investors in the market, all investors in the market can borrow and lend out, basically lend out any amount of money at risk-free. So that is also another important basically assumption that you must always tend to have in the event that we are dealing with aspect of CAPM. So you'll find that these are very important concept which you must always tend to have at our fingertips anytime we are handling CAPM, the assumptions, because these assumptions are the one that will always tend to guide us as we proceed. So make sure that you've mastered this assumption. Beta factor, capital market are efficient, all securities in the market are liquid and divisible, all investors in the market can borrow and lend out any amount of money at risk-free. And that's why I mentioned that at this point, you can't handle it effectively, not unless you can recall what we did earlier on in relation to basically capital market line, the CML. Okay, so maybe just to demonstrate this concept clearly, look at this, and this basically will give us the basis of CAPM. This will actually give us the basis of CAPM. So in this case, we want to determine the CAPM or security market line, right? Talk about CAPM or CML line. These are what you must always tend to have at the back of our mind if we are to demonstrate it. If you are to demonstrate it, make sure that you mastered this correctly, because it will guide us. It will guide us. It will guide us, right? I know right now you are like, wow, CAPM is always flowing like that. I know you're saying like that. That is how easy CAPM is. Understanding the concept first, right? So in this case, talk about this return of our security here, and I'll be having the risk. You say that risk under CAPM, basically the whole idea will be what? Beta, right? So I'm having our risk here, which is measured by our beta, which we mentioned earlier on. Okay, so in this case, of course, my risk-free, I'll be having it from, say, somewhere here, which is basically a straight line, which in this case, these are risk-free, right? At that point, this is basically I'm having a risk-free return or rate here. Then these are our CML, these are basically CAPM or CML, right? So here is where our efficient frontier curve will come in, whereby we normally tend to look at our, I can just have it roughly, efficient EFC, right? Our efficient frontier curve. So capital asset pricing model that we should always tend to have at the back of our mind, because recall here CML, this is a CML, basically CML, that is of course a capital market line, is always aspect to do with standard deviation, and SML is always aspect to do with beta, whereby to dissect that further, remember this we did, I'm only trying to recall, reminding us what we did. Recall, my good students, when we talked about, this is very important that you have in mind. Recall, maybe you can have it as NB. Recall when we mentioned that for us to determine our return of the portfolio, where we are having our risk-free component, we should always be having our risk-free here, right? Of course, plus our expected return of the market minus our risk-free. In this case, you are taking our standard deviation of the portfolio over standard deviation of the market. And many a times, of course, standard deviation of the market, we always take it to be, we normally assume it to be 1, right? So in this event, looking at this, what we did. So we've said that under CAPM, we are going to measure our risk using what? Beta, not standard deviation, right? Because under unsystematic risks, we are talking of what? Standard deviation. But in the event that you're talking of systematic risk. My CAPM talk about CAPM equation, talk about our CAPM equation, what you must always tend to have here. In the way that, of course, I want to determine the return of our security, return of our security here, that is return of the security, RS, right? Return of the security, the same concept will basically apply, where we are going to talk of our risk-free, my good students, okay? We are going to add our expected return of the market, okay? We are going to less our risk-free, but the measure of risk is what will change. The measure of risk I'll be using standard, or rather I'll be using the not standard deviation, but beta of our portfolio over our beta of the market, beta of the market. But the whole idea here which will be the same. The whole idea like of unsystematic risk, you'll find that the same case will also apply here. So the only thing that we must also be very keen at here is that the beta of the market is always 1. Beta of the market here is always 1. The beta of the market, which you must also be having at the back of your mind. Beta of the market, you're saying, is always 1. Is always 1. A trick that Mwalimu is giving us, that beta of the market is always 1. So this is to say that simply we can say that under CAPM equation, therefore, if we are to summarize it, return of our security will be determined by taking our risk-free here. We add our expected return of the market minus our risk-free here. This time round, I just multiply by beta of the portfolio, beta of the portfolio, beta of the portfolio. So this is what we are referring to as CAPM, whereby from our assumptions, recall, we say that at this point, basically our measure of risk will be beta factor. Our measure of risk will be beta factor, will be beta factor, will be beta factor. So that is very, very important that we do understand. That's very, very important that we do understand. So on this case, I want us to do something very quickly, whereby it will assist us to understand this concept further. And in that case, you'll find that the big question that one of us will ask Mwalimu, how will we determine the beta of the security? For beta of the security here, beta of our security, beta of the security here, beta of our security, beta of our security. When we are supposed to determine our beta of the security, given the return of the security and return of the market, you'll find that beta of the security, it will be very easy. We'll be having the covariance of security of the market. I'll be having here the covariance of the security of the market, okay? We divide by our standard deviation of the market. We divide by our standard deviation of the market squared. Divide by standard deviation of the market squared. So this will give us simply the beta of our security. That will give us beta of the security. Beta of the security. So this is to say that if the security beta are given, then the combined beta of the portfolio will be the weighted average of the stock betas. That is in the event that we are given the security beta. Then the combined beta of the portfolio will be the weighted average of the stock beta. So maybe just to demonstrate what Mwalimu is talking about, for us to determine this beta of the portfolio, how will we be able to handle it? How will we go about it? Quickly, let us look at a very simple illustration here, which, by the way, that case you can just have a very simple example. You can have a very simple example here, so that we have it in mind clearly. Okay, I know now. Remember, like CAPM, as you've realized, it's not just about formulas, but understanding how we are achieving this and why are we not achieving this and that? So take for example, in this case, maybe I'm having this stock. I'm having here talk about maybe talk over. I'm having our security, which you have in stock A, B, and C, for example, in this case. Then we also having the number of securities here, number of securities. Number of securities you have, say like 10,000. Talk about 20,000, and maybe you're having say like 30,000 here. Okay, 30,000. Just a matter of what you're talking about. Then market price per share. The market price per share, for example, market price per share, maybe you're having 0.5, maybe you're having 1, for example, and 0.5. These are just basically the figures that we are taking. Then beta of securities, beta of the securities here, beta of the securities, beta of the securities, beta of our securities. Yeah, we can take say like beta of securities. Maybe you're having say like maybe talk of 5, maybe 0.8, for example. This is 0.8, maybe 0.1. Just a simple example that I want us to handle. Just a simple example that I want us to handle here. So once we have that case, you'll find that we say that if the security beta are given, right? If the stock or security betas are given, the combined beta of the portfolio will be the weighted average of the stocks. Will be the weighted average of the stocks. Will be the weighted average of the stock. So here, things will be very easy, assuming you are required to compute the beta of the above portfolio. So required here, for example, we are required to compute the beta of the above portfolio, compute the beta of the above portfolio, compute the beta of the above portfolio. So how will we work it out? We need to determine the weighted average. We need to determine our weighted average here. And for weighted average, simply, you'll find that this will be very easy. Why is Mwalimu saying that it will be very easy? This is what we are going to take. Allow me to erase this bit here. So first of all, remember we want to determine the weight, and the weight, it will be, of course, on the average that we'll be having. So where, in this case, that will just be simple. Having the number of security and you're having the market price per security. So therefore, the values of our security basically should be having 10,000 times 0.5, that should give us what? 5,000, right? 20,000 by 1, that should give us 20,000. And 30,000 by 0.5, that should give us 15,000. I believe that is what we are having, right? So that as at the end of the day, if we sum it up, I want to determine the weight. This should give us 40,000. So once we have that case, this is what we must always tend to have at the back of our mind, that beta of our portfolio will always be our weight of the security that I'm given, weight of the security, assuming weight of security A times beta of A, we add weight of B times beta of B, we add weight of C times beta of C. These are what will give us ideally the aspect of beta of the portfolio, because we've clearly stated that if securities betas are given, then the combined beta of the portfolio will be the weighted average of the stocks beta, right? So in this event, after having all this, we can determine our weight of each item. Weight of security A, weight of security B, weight of security C. We can easily determine that. And how will you determine that? In this case, assuming I need this weight, so weight here, weight of weight of our securities, I should be having 5,000, of course, divided by 40,000. I should be having 20,000 divided by 40,000, and I should be having, of course, here 15,000 divided by 40,000. All you want to achieve simply here is basically what? The aspect of weights. So I'll take my calculator. We work it out together and see what we will be having. So this is what we should be having. Of course, here I'll be having our 5,000 divided by 4,000. This should give us 1.25. 20,000 divided by 40,000, of course, this should give us 0. This should give us 5,000. Sorry, 5,000 divided by 40. This is giving us 0.125. 0.125. Whereas this one should give us 0.5. And lastly, 15,000 divided by, of course, 40,000. This should give us 0.375. So at the end of the day, it should total to 1. So once we have this case, you'll find that to determine this beta, that will be easy, because weight of security A, I'm having 0.125. You multiply by beta of A, which our beta was 5. In this case, you're going to add weight of B, which is 0.5, times security of, or rather beta security of B, which is 0.8, beta of B. Then I'm having, of course, aspect to do with, that is weight of C, 0.375, times the beta of security C, I'm having 0.1. So if we add all this together, which in this case I should be having 0.125 times 5, we add 0.5 times 0.8, we add 0.375, multiplied by 0.1, this should give us, of course, 1.0625. This is basically the beta of our portfolio. That will simply give us beta of our portfolio. So this is one task that basically we should always be able to understand, which Mwalimu was clearly demonstrating to us how we can achieve the beta of the portfolio. In our next class, my good students, I want us to handle a full question which we are required to use CAPM, and I believe by the time you are through with this question, you must be very, very good when it comes to capital asset pricing model. So go through what we stated that you must be very good at even before you look at CAPM. So to this point, guys, thank you so much, and let us meet in our next session. Thank you.